Welcome back, you guys. It's your boy, the Educated Weirdo, as usual. We're here talking about the charts. If anybody's wondering why I have these patterns in the left and the right corner of the screen, it's because when people look at the market, this is exactly what they see nowadays. They get dazed. They're like, what in the world's going on? Don't worry, the Educated Weirdo is here to get you acclimated with what's going on. Today, we are tackling the continuation and reversal patterns. So let's get right into it. All right, now I won't read this off verbatim, but basically in a nutshell, continuation and reversal patterns are geometric shaped patterns that present themselves in a chart format. And you can actually see the charts and the actual shapes themselves manifest on the charts. Now, all the traders in the world learn these patterns. So when they see them, it's pattern recognition, basically. So we know exactly what to do when we actually see these particular shapes manifest. So in a nutshell, that's basically what's going on when you see these particular shapes. And to get a little bit more detailed, it's just the shapes themselves are price data manifesting in the form of like different geometric shapes basically on the charts. So you want to take a second to pause the video and just read the actual real definition, because that was just me summarizing there. You're more welcome to do it. We're just going to keep rolling forward. All right, so let's get right into it. Continuation patterns. All right, so we're going to go from the left to the right. The first pattern that we have there is a bullish flag pattern. So basically what happens is, if you guys can see my cursor moving around a little bit so you can see there. All right, so price action comes into a channel, a downward sending channel. So it's actually overall wise an uptrend is what this is signifying going into this. Then it briefly goes into a downtrend and starts creating higher, lower highs, lower lows, lower highs, and so forth. But overall, while in totality, it's still in an upward trend. But this would be if you were, say, going down to like a lower time frame and actually looking at it. But either way, we won't get into all that jargon now. Its price action is bouncing in a particular channel in a brief downtrend. Basically what a bullish flag is signifying is that price action is working its way down, but it's only momentarily. It's building up momentum to burst out the top of the channel, and it's actually going to continue to the upside. So all the patterns that we're looking at now are basically doing the same thing in a sense. They're briefly taking a pause to build up momentum to continue the pattern itself. The bullish pennant pattern, same thing is happening. Price action is getting a little tighter as it goes towards the top or to the right of the actual pattern itself. But the same thing that happened on the bullish flag pattern is going to manifest itself in the bullish pennant pattern also. So same thing over here with the bullish falling wedge. I won't bore you with the last three on the bottom because it's basically the same concept. The only difference is with the ones on the bottom, instead of it actually going to the upside, the same thing is happening to the downside. But it's still a continuation of the downward movement, in this case on the three on the bottom. The price action is coming from the top and working its way down. And it pauses briefly, somewhat consolidates to get more strength. And then it busts out of the actual channel or the pendant or the wedge that is following, and it continues the pattern. In this case, for the three on the bottom, that would be to the downside. All right, so take a look now at the reversal patterns. Okay, the reversal patterns, just like in the continuation patterns, price action is going in a certain direction. It comes into a brief consolidation. And in the bearish double top, it actually creates a double top here. So that's one top, two tops. So it's creating a higher high, then it goes for a higher low, then it creates another higher high equivocal to the first higher high. So they're symmetrically or horizontally straight across from the neckline. The bottom of the neckline, or whatever, the length from the neckline to the top of the higher high actually is equivocal. So what I'm saying here is this and this actually should measure about the same. Now, sometimes in the real world, they can be slightly off, but for the sake of this video, let's just say they were exactly the same. Now, instead of like with the continuation pattern, price would have continued on the upside. In this case, we are dealing with reversal patterns. So once it creates that higher high, it actually breaks the neckline, and the blue line there is the neckline. it actually goes back in the opposite direction. So it's a full-on reversal. And not to bore you with all three of these, you guys can read, you can pause the video, you can go over each one. The bearish, head and shoulders and so forth, and bullish, inverted head and shoulders, and all these other ones also. But the same thing happens basically on all these other patterns. It's a brief moment of somewhat consolidation, and it continues in the opposite reversal direction of the way that it was initially coming in. So we were in an uptrend on these top three here. Consolidated this one, consolidated on that one, and consolidated on the third one over here. Then it turns around and it reverses all the way to the downside. On the bottom, same thing, except you're coming from a downtrend already, and consolidates, and then you go in reverse towards the upside. So now I know what some of you guys are thinking. Okay, so we did a continuation and we did the reversal patterns, but how would you trade these? All right, so let's answer that question. Let's look at reversal patterns, since that's the last one we just done. All right, so I told you guys what the neckline was earlier. So instead of it being blue on this screen, it's actually red here. But let's go to the double top here on the left side. See the red one? If you can see my cursor moving around. Not sure if you can or not. But the neckline, the key to all these are the neckline. When you get in a trade, you just follow price action and you see what price does. You wait for it to hit the neckline and you see if it bounces off. In the case of a double top, if I see it bounce off and it comes back and it comes back for a retest, this is when I'm going to set. And then now there's other confluences that I would do to actually definitely jump into the trade. But for the sake of argument, let's just say all my confluences lined up and I actually jumped into the trade here. Okay, so what I would want to do is I want to enter the trade here and I want to put my stop loss down. These pictures were already drawn up, pre-drawn up prior to me doing this video, but honestly, sometimes I will put my stop loss where I actually drew it, but sometimes I will put it above the actual last higher high also. If you measure the neckline to the top of the higher high here, you can see the cursor moving. If you measure that, you'll notice that is the same exact distance from the neckline to my target that I'm going to exit the trade at. So see what I did there? So literally you could just box that up, clone it, and put it down there, and you will know exactly where you want to get your take profit levels to be if you trade with take profit. But most advanced traders, or even not even advanced traders, just your typical day-to-day guy casually trading or whatever, they're going to use stop losses and they're going to use take profit. So it would behoove you to follow in those footsteps as well. All right, so if you go to the head and shoulders, the same setup basically from the, now in this case, you would go from the middle, you would go from the neckline to the higher high here in the middle, measure that and then clone it, paste it here, and that would give you the exact measurement. So when you actually enter the trade on this reversal, you would want to have your target points here. So if you look at the rising wedge here, you'll see I somewhat did the same thing with that one. Stop loss is above the price action. Entry is below if it actually breaks this bottom portion of the wedge itself. You want to enter the trade. With that one, I measure from the top of the last higher high here, and I measure down to the bottom here, because the cursor moving. And basically that measurement from there to there is the distance that I'm going for when I actually go for that particular trade. So you'll notice with a lot of these patterns, a lot of the take profits that you're going for is based off mathematics, or the distance that the actual price action is giving you when it does is double top, or it's head and shoulders, the middle of the head and shoulders to the neckline. So you're basing it. So in other words, there's no, I don't want to give you a set number, because there is no set number. It changes per example or per actual trade itself, if that makes any sense. All right, so won't bore you with the jargon. I don't like my videos to be too long. So I notice a lot of you guys have short attention spans, so I try to talk fast, get right to it, man. So we're gonna jump on to the continuation patterns, And you'll see the same thing happens, but instead of it being a reversal, this is a continuation pattern as I stated. So therefore, when price action consolidates, you just wait for it to break out of the pattern. You set your entry point, you set your stop loss below the pattern itself. Once again, I have these kind of tight. Some people would drop it down a little lower. Me, myself, sometimes I do that as well, as I specified earlier. But for the case of this video, I want you guys to have tight sniper entries. So I'm keeping all my stop losses tight. So that way, if it goes against me, it gets me out of the trade right away. And just something, I know I'm doing a rattling or whatever, but just something a lot of advanced traders will do. They'll have a lot of stops. So if you look at their record, you'll see them losing a lot. And you're like, oh man, these guys are losing all the time. But in actuality, looks can be deceiving because their tight stop losses allow them to get out and take like minimal losses. So when they actually do have a win, the win is so devastating that it wipes out 10 losses in a row. Now, I don't exactly trade like that, but that is a way that I have seen a lot of people trade, and they're real profitable doing that. But myself, I don't like to do that. I like to give the trade a little bit of breathing room, because sometimes the market makers or the smart money, they'll go on like a stop run, and they'll actually just wipe out your stop losses on purpose, and then it'll reverse and go in a direction that you initially thought it was going to go in to begin with. So but we'll save that manipulation in the market for another video. So with the wedge, with the rectangle, different ones is on here. You can see it's self-explanatory. You get in at the entry point outside of the actual patterns itself. You set your target usually for the same distance as the price action in the consolidation period, and then you clone that, and that's how you actually make your entry and your exit also. And the opposite side of actual consolidation would be where you put your stop loss. All right, so that's going to be it, you guys. Well, actually, you know what? Let's do one. I got one more bonus for you guys. There actually are some patterns that are, I guess, bilateral. So they can either go left, they can either go up or they can go down. And I have them here. The ascending, descending, and the symmetrical triangles are 3 examples of this. So in this case, you would just have to watch and just basically be in front of the chart, or actually set a pre-order to go off automatically depending on which direction price action actually breaks out of the particular pattern that is following. And then once it breaks out, the same thing applies to the other patterns that went over earlier. The same thing applies here. You go into your entry, you actually go to the highest and the lowest point of the consolidation to give you your actual target points and your exit points, and your stop loss would just be on the opposite side of whichever way price action broke out at the, usually, like I said, you could put it right below the where it actually broke out at the actual pattern itself, or you can drop down below a little bit further to give yourself a little bit more breathing room if you trade with just a little bit more risk in mind. Either way, all of it works, man. If you learn these patterns, it's just a part of a conglomerate of different things that you have to learn. But if you learn these parts, man, these patterns, and you do your due diligence and you stick with the educated weirdo, we will have you day trading, or we will have you swing trading, or whatever you're trying to do. And even if you're not trying to do any of that, if you're just trying to invest, it's good to know what's going on in these charts, man. So I'm the educated weirdo, signing off. Much love and respect. You guys like and subscribe. Come back and see me whenever you get a chance. I'm dropping more videos probably later this week or whenever I can. I'm here for you guys, man. So just I appreciate if you like and share and just return the love, man. All right, much love and respect. I'm out.